By the end of this video, you'll have a comprehensive roadmap to craft an effective business exit strategy that ensures a smooth transition, maximizes the value of your business, and reduces risk for you and your family. Failing to plan your exit strategy could lead to significant financial loss, a rushed sale, or even the collapse of your business after you leave. For instance, if you don't start early enough, you could be forced to sell your business at a much lower price than it's worth or face complex legal battles. But don't worry, by the end of this video, you'll understand exactly how to avoid those pitfalls and create a successful, strategic exit. I'll walk you through the key steps, why each is critical, and real-life examples to help you make the best decisions when it comes time to exit. The first step in crafting an effective exit strategy is to start planning years before you intend to exit. A common misconception is that exit planning is something you can do a few months before selling the business, but in reality, effective planning requires a multi-year approach to increase your business's value, streamline operations, and ensure you have time to address potential risks. Starting early gives you time to build value in your business and reduce operational inefficiencies that could harm its sale price. The earlier you plan, the more leverage you'll have when negotiating your exit, whether that's selling to an external buyer, passing it on to family members, or handing over to a trusted employee. If you wait too long, you may be forced into a rushed sale, which could lead to selling at a loss or facing additional costs and complications. Starting early helps you identify and address issues, whether that's employee turnover, low profitability, or legal inefficiencies. Let's say you own a family-run construction business and you plan to exit in 5 years. If you begin planning today, you can work on expanding your client base, improving your financial records, and addressing operational issues that might lower your business's value. For example, you might invest in new project management software to streamline workflows, improving both employee productivity and client satisfaction. Over time, this could make your company more efficient and increase your profitability, which in turn will make it more attractive to potential buyers. Additionally, by addressing inefficiencies, you'll be able to reduce any potential liabilities that could deter buyers and maximize the sale price when the time comes. Now that you understand the importance of starting early, let's move on to defining your exit goals, which will shape the entire exit strategy. Before doing anything else, you need to clearly define your exit goals. What do you want your exit to look like? Are you planning to sell the business to an external buyer, pass it to a family member, or transition ownership to a key employee? Your goals will determine the entire structure of your exit strategy. Setting clear goals helps you make decisions that align with your objectives. If you want to sell your business to a third party, you'll need to focus on increasing profitability, improving operational efficiency, and marketing your business to potential buyers. On the other hand, if you want to pass it on to a family member, you'll need to consider succession planning, training, and the emotional dynamics that come with handing over the reins. Defining your exit goals helps you avoid wasting time and resources on an approach that doesn't align with your objectives. For instance, if your goal is to sell to a strategic buyer, you wouldn't waste time training a family member to take over the business. Instead, you'd focus on enhancing the business's profitability and streamlining operations to attract buyers. Imagine you own a boutique digital marketing firm. If your exit goal is to sell to a competitor, you might focus on increasing client retention and establishing long-term contracts. This means investing in stronger customer relationships and ensuring your company's growth trajectory looks attractive. You could create a detailed portfolio of your success stories, which would help position your business as a highly valuable asset. But if your goal is to pass it on to your daughter, who is interested in running the business, your strategy might involve developing her leadership skills, gradually transferring key responsibilities to her, and ensuring she is capable of taking over client relationships. In this case, your exit strategy will focus more on mentorship and ensuring her readiness to lead the business after you step away. Now that you've identified your goals, the next step is to assess your business's current value and determine how to increase it for the best possible exit. Next, you need to assess the current value of your business. The value of your business will play a significant role in how much you can sell it for, or how you can structure a transfer of ownership. An in-depth assessment involves reviewing financial performance, market position, operations, and customer relationships. If your business isn't worth what you hope to sell it for, you need to take steps to increase its value. Your business's valuation will largely dictate the terms of your exit. If the business is worth a lot compared to your competitors, you'll have more options for who you can sell it to, and you'll be able to negotiate for a higher price. The more valuable the business, the greater the opportunity to maximize your financial return. By assessing and increasing your business's value, you avoid selling the business for far less than it's worth or being forced to sell at a lower price due to lack of preparation. If the business value is low, you may struggle to find buyers or receive a price that reflects your effort and investment. Let's say you own a software as a service business. Before you sell, you need to evaluate the recurring revenue model, customer retention rates, and overall profitability. If you focus on improving customer support by offering 24/7 service, refining your software to increase user retention, and securing long-term contracts with clients, you can raise your business's value significantly. For example, by offering added services, you could reduce churn rates and make your business more predictable in terms of revenue. These improvements will not only boost profitability, but will also attract higher quality buyers, who are willing to pay a premium for a business with predictable income streams. The more you optimize the customer experience and ensure long-term stability, the better positioned you are for a successful sale. Now that we've covered increasing business value, it's time to think about the tax implications of your exit and how to manage them. Selling or transferring ownership of your business can have significant tax implications. This includes capital gains taxes, estate taxes, and even potential gift taxes, depending on how you structure the sale or transfer. Understanding these taxes and how to mitigate them is essential to keeping more of the money you've worked hard to build. By understanding the tax implications early, you can structure your exit strategy in a way that minimizes your tax burden, preserves wealth, and maximizes your financial outcome. Tax-efficient planning will help you save thousands or even millions of dollars when you exit. This step helps you avoid being caught off guard with high tax bills that could significantly reduce your take-home value or even make it difficult to execute your exit as planned. If you sell your business, the IRS will typically tax the profits from the sale as capital gains. However, by structuring the sale through a tax-deferred method like an installment sale or using qualified small business stock (QSBS) provisions, you can reduce the amount of tax you pay. For instance, QSBS allows for up to a $10 million exemption on gains if the business qualifies, significantly reducing your tax bill. This kind of proactive planning can have a massive impact on the proceeds you ultimately take home, allowing you to retain more wealth to reinvest or use as you see fit. Now that you understand taxes, let's dive into creating a succession plan, which is especially important if you're passing the business down to family members or trusted employees. A succession plan is essential if you plan to pass the business on to family members, key employees, or partners. The succession plan involves identifying the right person to take over the leadership role, grooming them for the position, and ensuring that the business can continue operating smoothly after you exit. Without a succession plan, your business could experience instability after your exit. This could lead to conflicts among family members, mismanagement, or even a failure of the business. Planning the future leadership ensures that the company can continue without missing a beat. A clear succession plan helps mitigate leadership gaps, family disputes, and operational disruptions that could arise from an unclear transition process. If you run a family-owned law firm and want to pass it down to your daughter, you'll need a detailed succession plan. This may involve mentorship, transitioning client relationships, and establishing legal frameworks for ownership transfer. For example, you could start by gradually giving her more client-facing responsibilities and involving her in key decision-making processes. Additionally, you might bring in outside training to ensure she has the necessary skills to manage the business effectively. By the time you're ready to exit, she'll not only be prepared to lead but also emotionally connected to the business, ensuring a smoother transition for both family and clients. Now that we have a solid succession plan, let's focus on ensuring the actual transition process goes as smoothly as possible. Whether you're selling to an outside buyer, passing your business to a family member, or transferring ownership to a key employee, ensuring a smooth transition is essential. This involves planning how operations will continue, how the team will be managed, and how your customers will be taken care of during the process. A smooth transition ensures that your business continues operating without interruption after you exit. A chaotic transition can lead to a loss of customers, employee turnover, and a decrease in business value. By planning for a smooth transition, you avoid losing customers, causing employee unrest, or damaging the reputation of the business during the handover period. For example, if you are selling your business to a competitor, you would need to work on integrating your staff, clients, and systems into the new structure. This might involve working with the buyer for several months to ensure the business culture remains intact and clients are retained. If you're passing the business to a key employee, this may involve working alongside them for a few months to ensure they're ready to take over the leadership role. During this transition, you'll focus on maintaining customer satisfaction, ensuring that the leadership gap is filled seamlessly, and avoiding any operational disruptions that could affect your business's value. Now that you've learned how to craft an effective business exit strategy, don't miss our next video where we dive deeper into how to value your business for a successful exit. Check it out, and be sure to subscribe for more expert tips. Contact Matheau Stout today to discuss your business succession planning and estate planning needs.